Watch the numbers that come up here. So here's April for us when we made 3.5. Do you see the number 3288? 3,288. We can forget the 3 grand. We know it's 3 grand. So you've got 288. We can even forget the 2 if we want to. It's 88. 2 fat lazies. There we go. 89. The close on the month after April, May month, 89. The close on the month after that, 303. So we've got 88, 288, 289, 303. Then the close in July. So we've done quite a few months here. So let's start again. April, May, June, July. What was the close in July? 3290. So let's just recap. 288, 289, 303, and 290. So the 303 is $15 from the lowest one, 288. But we've closed 1 month, 2 months. Let's do it with a pink so everyone can count with me. 1 month, 2 months, 3 months, 4 months in a row within $15. We felt that there was going to be a dull period for a bit now after we had a failed breakout. We got kind of excited for potential breakouts and then it failed. This was at the back end of July month. And since then, we've expected a kind of a dull sideways and down market. I just want to highlight a few things, and this is probably best done technically as well as ever. We are the chart guys, if we're anything, and particularly on precious metals, it's such a good tell. So I'll show you a little bit about where we've been and why I think things could get interesting. Before I go to the monthly chart, I'm just going to show you the weekly chart. You may recall, and we were on your channel, I remember this quite specifically, and we highlighted this squeeze. And we throw a few catchphrases so people remember. We said once, that was the 2000 level is the blue line, twice, 3 times, and then a lady. That's your run. And we said you're going to run to 29,3000. That's the blue 3000 line, by the way. And then the one thing I want to highlight that happened after that, and for that I'll even take us down to the daily, is that we actually had fundamental events occur. Donald Trump went super aggressive with the tariffs in April, and it looked like he was picking a fight with everybody. You're on 30%, you're on 30%, you're going to be 100%, da-da-da-da-da, and it was quite wild. It was a bit like a drunk barroom brawler who's taking on all comers and swinging from the bleachers a little bit. Not to mischaracterize him, but it was a little bit out there.
Technical charts often provide the earliest clues to market behavior. Gold's resistance around $2,000 was tested multiple times before finally breaking higher toward $3,000, fulfilling long-held forecasts. That surge, however, was supercharged by external shocks, including aggressive U.S. trade tariffs and financial volatility. Rates spiked, the dollar weakened, and gold rallied all the way to $3,500, overshooting expectations. This overperformance signaled how fragile market confidence had become. But after that blow off top, the charts began flashing warnings. Since then, gold has been caught in a narrowing band, a technical squeeze that often precedes sudden and violent moves.
And we got this panic in April on the US debt markets. The rate shot up. The dollar actually went down, which is a key point in the warning to those dollar milkshake guys that rates can go up without the dollar going up with it. It can actually do the opposite. And we got this surge all the way up that went to a localized high of 3,500. And it's very interesting, that number, because it's obviously the round number. It's a bit of a derivative significance in terms of that for the derivative number. It's also closer to 4,000 because it was 3,500 and a fractal of a cent. So it was slightly closer to 4,000 than it was to the original 3,000. So that would have put the frighteners on a lot of the system coordinators and handlers. And since then, we overperformed a little bit because our target, as we mentioned, she was 29,3000. So we got a little bit of an overperformance. And now we've been hanging tough at a couple of levels. Now I'm going to take you to the monthly And I'm a little bit OCD when it comes to charts and noticing things, particularly in the precious metals game. So I'm going to just turn all my lights off there so that you can just see the candles. And when we were going up, we went out on YouTube. You can go and have a look. Precious metals might come down or pull back or go sideways and not do much positive and be a bit of a sell-off for a short, medium term. By the way, still macro, the biggest bulls, gold and silver out there. However, just made that 3,000, got a super surge blow-off run to touch the 3.5 and since down. Here's a really interesting thing, and I'd like everybody to do this with me. I've just done it. So watch the close. I'm going to put the pink box around the close.
A closer look at the monthly closes reveals something uncanny. Between April and July, gold repeatedly finished within just $15 of the same price level, around $3,088 to $303. For 4 months in a row, the market barely budged despite huge intraday swings. Such tight clustering suggests heavy intervention, likely linked to derivatives and hedging flows. Repeated wick rejections at higher prices hint that sellers are defending key levels. As of mid-August, gold slipped toward 3,170, reinforcing the sense that upward momentum has stalled. These subtle technical footprints can foreshadow larger corrections when macro stress resurfaces.
Watch the numbers that come up here. So here's April for us when we made 3.5. Do you see the number 3288? 3,288. We can forget the 3 grand. We know it's 3 grand. So you've got 288. We can even forget the 2 if we want to. It's 88. 2 fat lazies. There we go. 89. The close on the month after April, May month, 89. The close on the month after that, 303. So we've got 88, 288, 289, 303. Then the close in July. So we've done quite a few months here. So let's start again. April, May, June, July. What was the close in July? 3290. So let's just recap. 288, 289, 303, and 290. So the 303 is $15 from the lowest one, 288. So we've closed 1 month, 2 months, let's do it with a pink so everyone can count with me. 1 month, 2 months, 3 months, 4 months in a row within $15. 88, 89, 90, and 303. And that's a slight concern for me. And remember, I remind you that derivatives, month ends matter because of derivatives. And there quite clearly is wick selling in the second half of the month. Now, at one point in the early part of this month, this was all a green candle. And I said, don't get excited. It could come back down. Do you see how we're now the 19th? I don't know if you can see top right there, the date, 19th of August. So the trading days left of this week are far less. We've got another weekend to come to. There'll probably be 2 more weekends. So actually, we've only probably got maybe, I don't want to speak out of turn. I haven't counted them, but 10 more trading days.
Where gold goes, silver often follows, only with sharper moves. Historically, silver acts like gold's high beta cousin, amplifying both gains and losses. After gold's recent exhaustion, silver has mirrored the weakness, showing clear breakdowns on daily charts. Alerts across trading desks confirm accelerating sell pressure. Despite tight physical supply, paper markets continue to dominate short-term pricing. If gold dips further, silver could fall even harder, shaking out weak hands. Long-term investors remain confident in the metal's role as a hedge, but in the near term, volatility may increase sharply, particularly if macro shocks intensify into autumn.
And this wick has come all the way back down, and we're now at 317. So the highest was 303. So this to me is a little bit of, if I just put in the current closes in a box, that's the current closes for gold. How narrow is that? And then I say, this one's coming on back down too. So it's an observation. And it points to these selling wicks are rejections. Are rejections for me. And they're all on the high side more recently. So this one over here, you also had a test to the downside and you came back up. So it was at least floor and ceiling. This is all about being resisted up top and coming down. Now, what goes for gold leans on silver even harder, because if we get a sell-off in gold, as we know, typically we get a little bit of a higher beta sell-off in silver. That means silver can retrace. So we've been not trading long after being aggressively trading long since this period here, when we were telling you about once, twice, three times, and then the lady, which was a great period where actually in monthly terms you had 1, 2, 3, call it 4, 5, 6, 7, 8 months in a row before you had 2 negative ones, and then you had another 1, 2, 3, 4 green ones. So you had 8, 2, and 4. So you had 12 green months, and you only had to sit through 2 down months, and one of them was incredibly small as a red body. So that period, that overperformance period with that final surge with the Trump tariffs, has made gold and silver a little bit overcooked. You and I have run a marathon. We've gobbled 3 pizzas and had 5 beers each. We're not about ready to get off our couch and go run another marathon.
While technicals warn of fatigue, the real risks may come from global debt markets. The UK in particular faces mounting disorder as bond yields climb, threatening contagion. A similar dynamic played out during last year's carry trade unwinds, sparking volatility across assets. Historically, September and October are prone to financial shocks, with markets often repricing risk violently. In such scenarios, gold may initially sell off with everything else as investors rush to raise cash. Yet, in the medium term, debt instability tends to push capital back toward gold, reinforcing its role as a safe haven lifeboat.
So there's a bit of congestion there. There's a little bit of bloat going on. And that's kind of how we've characterized the gold market. And I think we're going to turn out being correct. And we've got a little bit of selling. And in fact, this close could not only pass 303, it could pass 3290, 3289, 3288, and it could actually close lower, and you could have your triggering events. So typically our tactical people trade shooting stars is they have a stop at the top of the shooting star and they short the bottom. Now you've actually got quite a few to choose from, but this one is going to be the smallest one. You went the least way up. You could short there. Now that would be tactical trading. I'm not going to do that, and people aren't going to like hearing that. But if we have a crisis of some form, I'm mentioning the UK debt markets are deeply disorderly and the rates are looking like they're due to spike. So the UK could bully its way to the front of the queue and you could have a bit of a contagion on the debt side. And it's normally, I would say, long run, it's very bullish gold, because people will drop treasuries for gold. But initially, when you're in that disinflationary vibe of panic, people sell everything that's not nailed down, and that could see gold come off. So we are slightly more concerned for gold and have been that way for 3 or 4 odd weeks. And currently the market is giving it to us exactly like that. If I take us down to the lower time frames and just put back on our eye, you'll see our technical. This is a wedge that we're falling out the bottom. And again, that's a bit of a knockback candle, and you're getting another knockback, and actually you're slipping out of the bottom of that falling wedge to the downside at the moment. And that's going to have a negative effect on silver. So XAG USD. As we were talking, I was apologizing for the noise, and those were alerts being pinged on silver. And what do we have? We have silver on a downside break. I'll again just hide all the works. You can see a little bit circumspect after a move up to the high over there and the sell-off.
Looking forward, 3 paths seem possible. In the moderate case, gold drifts lower within its current range, creating a buying opportunity for patient investors. A deeper correction could test key lows, rattling confidence but staying contained. The extreme case, a global debt crisis, might break gold beneath critical levels before setting the stage for a major rebound. As 2025 unfolds, much will depend on how central banks manage rates and liquidity. For now, traders must weigh short-term weakness against long-term strength. History shows that when crises deepen, gold eventually proves its enduring power as money's last safe harbor.
So that's, again, the day down, 2 indifferent flat days. We've had 2 days down and 2 nothing days. So there is a bit of heaviness, despite the fact that fundamentally I think silver is probably running low on supply, but the paper markets are illustrating that there's a little bit of fear out there, a little bit more fear.
What kind of downside potential do you see in both gold and silver at the moment?
Okay, so let's go back to the boss, which is the king of the metals markets. I'll just pull up gold there, and I'll show you ranges which will give us an idea of degree. I threw a couple of boxes on this when I was discussing this. First of all, that is the 3,500 high and then the subsequent 3,120 low. That was our first reaction after that blow off top. That's one box. There's another more slightly inside the range box. That was the secondary high. Whoops, let's get a better color than yellow. Sorry for that. Let's go blue. That's what we were looking for. You've got a localized high and a localized low there. Now, it's a question of 3 degrees of badness. This could all end, and you could come and you could maintain inside this range and just test a new low here. So that would be moderate down. Nobody's crying too much in terms of the long-standing precious metals stackers. That's maybe even just a small buying opportunity. They're not upset about that. You could get a deeper dip if I go the pink option, and then you could run that low and this low, localized low, and you could stay within the larger range, but not run the 3,120. And then there's the exceptional item, which would be, we have a real September, August, October crisis, say with the UK debt, and we have a choppy market and everything is being sold and there's mad panic, and we break that low. I think we're going to probably remain in range unless we have an exceptional crisis, but I will highlight August last year, second half, was the carry trade unwind shock. And September, October are that period where a demand-destroying event, as we've referred, and you get that disinflationary assets crash, and that would probably include the stock market as well. People are getting a bit more circumspect about the pricing on the US stock market. You could probably have corrections September, October that could get disorderly there.